On the anniversary of Bitcoin nearly hitting $20,000, we could not be further from that euphoria we were feeling at the time. Realistically, no one has any idea when we'll hit capitulation, when we'll find a bottom, what that will look like, how long it will take, and generally what the market will look like in 2019. Furthermore, I say there's about a 95% chance the US Securities and Exchange Commission will deem the cryptocurrency market unready for the handling of a large-scale investment vehicle like an ETF. Based on the wild volatility in prices of major cryptocurrencies over the past year, and the lack of surveillance in smaller markets, this should be pretty apparent. Combine that with the fake volume and wash trading that we're seeing across the cryptocurrency markets. An ETF is simply the wrong thing at the wrong time. But that's not a bad thing. In fact, as I'll argue, us moving away from the ETF and the hopium that it brings will be one of the best things we can do for ourselves in 2019. So let's explore that. Let's talk about why 2019 is not the year of the Bitcoin ETF and why that's a reasonable and very beneficial thing. Welcome to ReadySetCrypto. This is your brain on blockchain. So crypto exchanges have been the primary on and off ramp for investors looking to get in or out of cryptocurrency ever since Satoshi ushered us into this new decentralized age. Ever since then, exchanges have grown fat off the proceeds, in some cases making profits bigger than mainstream banks, as we saw with Binance overshadowing Deutsche Bank earlier this year. But it's clearly apparent to me that over the coming years, the SEC and other regulatory bodies are going to spoil the party. As we've seen regulators crack down on ICOs over the past year, we're going to see the same thing happen with crypto exchanges. So seemingly in response to this, the crypto industry is looking to pivot towards selling security tokens and actual security offerings, in addition to creating dedicated security exchanges to trade them on. Now, this is great news for institutional investors and accredited investors looking to get into the space. But it's bad news for people who aren't exactly able to meet a security exchange's stringent requirements. After all, will this help us get out of our nuclear winter? Or is it just another way for the rich to get richer? Now, security exchanges are, quite simply, an exchange for the trading of securities. They have strict rules, including anti-fraud measures and periodic reporting requirements, that make them a less risky experience compared to the crypto exchanges we're familiar with. Most crypto exchanges don't do anything beyond simple KYC, if that. And this has allowed them to practice things like wash trading and market manipulation. Quite honestly, when you hear people talking about market manipulation and people manipulating the crypto markets, it's not Wall Street that's doing this. It's these crypto exchanges that seem fit to fake their volume and manipulate the crypto markets to their own benefit. I mean, if you really want to look at the problems facing the crypto industry, I think we should take a hard look at how exchanges are exploiting both projects and us as investors. Based on information from blockchaintransparency.org, the average project spent over $50,000 this year in listing fees from exchanges. Based on some napkin math, this adds up to an estimated $100 million stolen in 2018 from the crypto ecosystem. They point to over 50 exchanges wash trading over 95% of their volume. Some exchanges made over $1 million this year just from collecting these fees. And yet, if we take a hard look at the percentage of real volume, you can see that authenticity is the exception, not the norm. I mean, you can verify this yourself by just going to the rankings of the top exchanges on CoinMarketCap. I mean, so look at this. This is terrible. Over the past 24 hours, we can see that exchanges like Binance, which Blockchain Transparency listed as legitimate, has lost 19% of its volume. Whereas other sites like ZB.com has gained 33%, or HitBTC, which has gotten 62%. You know, while I was researching this video, I had a fun time coming up with pattern names for the volume charts that we see on here, especially for volumes that look suspect. For example, you've got pot with water, you've got shrugging shoulders, you've got cardiac arrest, snake charmer, and probably the best one, BitConnect. Not only do these exchanges fake their volume and manipulate the market, they're also not particularly safe. Nearly $1 billion has been lost to exchange hacks. This is why institutional investors have stayed out of crypto trading. They need these safeguards in place in order to bet with their clients' funds. Now, upcoming security exchanges have promised to fix that. There's a lot of hope riding on exchanges like Bakkt, which is owned by the same owners of the New York Stock Exchange, itself being a security exchange. Bakkt will meet regulatory requirements, providing a facility for institutional investors. However, as we've seen its launch be pushed back twice now, even regulatory bodies like the CFTC are not exactly making it easy for security exchanges. I think the problem stems from the fact that, at the moment, many cryptocurrencies are part security, part commodity, part something else. We see that in the regulation of cryptocurrencies because one regulatory body, like the SEC, will view it as a security, whereas another government agency, like the IRS, might see it as property. And certainly this uncertainty makes institutional investors so hesitant to jump in. And look, as much as it would be nice to see liquidity injection into the market right now, that simply won't magically happen if the ETF is approved. The SEC's concerns, which haven't changed, are market infrastructure and market manipulation. And they're not alone. Institutions are not going to invest their clients' money in a volatile asset until they can be assured of the custody and the stability. Right now, custody solutions for institutions is few and far between as it relates to crypto. And the market has clearly shown that even at these levels, we can still move a tremendous amount in one day. So that being said, I think we are going to get the infrastructure we need, or at least part of it, in 2019. I'd rather have the market ready and then have the ETF approved instead of the other way around. Unfortunately, what most of us don't want to hear is that the market won't return to previous highs over the next year. But the way I see it, that's a great thing because it allows the market another year to develop, expand, and mature without unrealistic expectations. Add on to this the continued instability in the equity markets, and I think cryptocurrency is going to emerge as a legitimate contender over the next couple of years. Frankly, the healthiest path for us is slow growth, platforms before an ETF, and to focus on stability in the face of global instability. The big opportunity for us is to present a better vision for the world as central banks continue to print money, as trade wars escalate, as consumer debt spirals out of control, and as the common person is left behind and forced to pick up the tab as too big to fail companies continue to take risks and take advantage of interest rates. But I hear you. How does that affect us today? After all, what can we reasonably expect if an ETF is denied in February? Honestly, it's anyone's guess, but I wager it won't affect us that much. I mean, think about it. Who is going to sell at these levels if they haven't already been convinced that the market is not going up? The ETF being denied probably won't be the final nail in the coffin for them, nor will it be for Bitcoin. Sure, we'll see a short-term spike in volume like we did in August, but I think our expectations are more in check this time. Quite simply, it isn't the right time for the ETF, and that's a good thing. Let's focus on developments, maturity, and other critical roadblocks. Sure, more money coming into the space would theoretically help, but we could just as easily see another 2017 bubble and burst. Our aim right now is to convince people that crypto is here to stay, that it's a worthwhile progression over legacy systems, and that it's not all about the insane hype and price expectations. In other words, it's time to stop giving ourselves a sugar rush and entertain a more balanced diet. So stick with it and we'll get through this together. To that point, I'm really excited to be offering my new STO class later on this week, so stay tuned for that. All right, I'll catch you guys in the next one. Thanks for watching. Cheers.